I want to talk to you about something deeply important, something that could decide whether your retirement years are calm and secure or filled with constant stress and uncertainty. At 94 years old, I've lived through 15 recessions, countless market crashes, and nearly every economic shock you can imagine. And as we move closer to 2026, I'm starting to see warning signs that strongly resemble some of the most dangerous periods I've experienced in my lifetime. The good news is this: if you're already retired or approaching retirement, there are 5 very specific investments that can help protect you from the turbulence ahead, while still providing the income and long-term growth you'll need for the next 2 or even 3 decades. These are not flashy investments. They won't make you rich overnight. But they offer something far more valuable: protection for everything you've worked your entire life to build, combined with steady, dependable returns you can rely on. I've personally leaned on these same principles to protect and grow my wealth through every major crisis since the 1950s. And today, I'm going to explain exactly what retirees should own before 2026, why these investments are more important now than ever, and how to position your portfolio so it can withstand virtually any economic environment ahead. The window to act is closing. The time to prepare is now, while you still have choices. Before I walk you through the 5 investments, you need to understand why 2026 is such a critical deadline. We're standing at a rare intersection in economic history, with several powerful forces converging that are likely to reshape the investment landscape in a major way by 2026. First, interest rates are sitting at levels we haven't seen in over 15 years, but their stability is anything but certain. The Federal Reserve is walking a tightrope between controlling inflation and avoiding a recession, and history tells us that policy mistakes are likely when the margin for error is this small. Second, the baby boomer retirement wave is accelerating. Every single day, roughly 8,000 boomers retire and begin withdrawing money from the markets instead of adding to them. That creates consistent selling pressure that will only grow stronger through 2026. Third, government debt has expanded to levels that will eventually force hard choices. Either inflation will be allowed to erode the real value of that debt, or taxes will rise significantly. No matter which path is chosen, retirees will feel the impact. Early in my career, I learned a lesson that has served me well ever since. The best time to prepare for a crisis is before it arrives. In 2006, I started shifting toward cash and safer assets because I could see the housing bubble expanding rapidly. Most people thought I was being overly cautious. By 2008, they understood why. Today, I'm seeing many of the same warning signals, and the steps I'm taking in my own portfolio are the same ones I believe retirees should be making now. The first investment every retiree should own before 2026 is Treasury inflation-protected securities, commonly known as TIPS. Let me explain what they are and why they matter so much right now. TIPS are government bonds that automatically adjust their principal value based on inflation. When inflation rises, the value of your principal increases. When inflation falls, the principal adjusts downward, but never below the original amount you invested. On top of that, the interest payments rise along with the principal. This matters because traditional bonds are extremely vulnerable to inflation. If you purchase a 10-year Treasury bond yielding 4% and inflation averages 5% over that period, you're losing purchasing power every year. TIPS solve that problem. If inflation jumps to 6%, your TIPS adjust upward to offset that loss. Let me share why inflation protection is so personal to me. In the 1970s, I watched inflation destroy the retirement plans of people who had done everything right. They saved diligently. They bought government bonds for safety. They believed they were secure. But when inflation climbed in double digits, their fixed income became nearly worthless in real terms. What could buy a nice dinner in 1970 barely covered a sandwich by 1980. I promised myself then that I would never allow inflation to quietly erode my purchasing power again. For retirees today, I generally recommend allocating 20 to 30% of your bond portfolio to TIPS. You can buy them directly through Treasury Direct or access them through mutual funds or ETFs at any brokerage. The key is to ladder them across different maturity dates so money becomes available at regular intervals. That provides both inflation protection and liquidity. There is one important caution. The inflation adjustment to a TICE principal is taxable in the year it occurs, even though you don't receive that money until maturity. For that reason, TIPS are best held inside tax-advantaged retirement accounts. To put this into perspective, imagine a 65-year-old roller with $500,000 allocated to bonds. If $150,000 is invested in TES and inflation averages 4% over the next decade, that TIPS portion would grow to roughly $222,000 in nominal value, preserving its real purchasing power. Traditional bonds paying 4% would grow on paper, but lose value after accounting for inflation. Now, let's move to the second major investment retirees should own before 2026. Dividend-paying stocks, specifically companies known as dividend aristocrats. These companies offer inflation protection because, unlike fixed-income bonds, they can raise prices when costs rise, which allows them to increase dividends over time. That creates a natural hedge against inflation. They're also resilient during recessions because they sell products people need no matter what the economy is doing. People still brush their teeth, take their medications, and buy everyday essentials during downturns. What makes these companies truly special is their long track record. A 25-year history of consecutive dividend increases means they've survived the dot-com crash, the 2008 financial crisis, the pandemic, and every major disruption in between. I learned the power of dividend-paying businesses from my mentor, Benjamin Graham, and refined that strategy over decades. The insight is simple. Companies that consistently raise dividends tend to be conservatively managed, generate reliable cash flow, and prioritize shareholders. In my own portfolio, and at Berkshire Hathaway, I've always favored dividend-paying businesses. Not because I need the income, but because dividend policy tells you everything about management's confidence. A company that raises its dividend year after year is saying, "We're confident enough in our future to commit to paying you more, regardless of economic conditions." For retirees, I generally suggest allocating 30 to 40% of your stock portfolio to dividend aristocrats. You can own individual companies if you're comfortable doing the research, or use an ETF for broad diversification. During your working years, reinvest the dividends. In retirement, begin taking them as income. That creates a growing cash flow that helps offset inflation. For example, a $300,000 investment yielding 3% would initially generate $900,000 per year. If dividends grow at 5% annually, that income would rise to roughly $14,650 after 10 years and nearly $23,150 after 20 years. That growth is what allows retirees to maintain their standard of living over time. The third investment retirees should own before 2026 is short-term Treasury bills, specifically maturities ranging from 3 to 12 months. You might be thinking they don't pay much, but right now they play a crucial role. First, they offer unmatched safety. Treasury bills are backed by the full faith and credit of the U.S. government. During uncertain times, that security is invaluable. Second, they provide liquidity. With short maturities, your money is never locked up for long. That flexibility allows you to handle emergencies or seize opportunities without selling long-term investments at the wrong time. Third, current yields are attractive. Short-term Treasury bills are paying around 4 to 5%, far better than the near-zero rates we saw just a few years ago. And most importantly, they provide optionality. This is what I call dry powder. When markets fall or interest rates spike, you'll have cash coming available regularly, cash you can deploy when prices are more attractive. In 2008, when credit markets froze and stocks collapsed, I had large amounts of cash and short-term securities. That allowed me to make some of the best investments of my career, precisely because I had liquidity when others didn't. For retirees, I recommend keeping roughly 15 to 25% of your portfolio in short-term Treasury bills. This allocation functions as your emergency fund, opportunity fund, and peace of mind money all in one. Ladder them so funds mature every month or two. There's also a psychological benefit that shouldn't be underestimated. Knowing a portion of your wealth is completely safe and liquid helps prevent panic decisions during volatile markets. The investors who do best in crisis are the ones who never feel forced to act. This brings us to the fourth investment, one that often sparks debate: immediate fixed annuities. Many annuities deserve their poor reputation. They're often complex, expensive, and designed to benefit salespeople more than buyers. But immediate fixed annuities are different. They solve one problem nothing else can: longevity risk. An immediate fixed annuity is simple. You give an insurance company a lump sum, and they guarantee a fixed monthly payment for the rest of your life, no matter how long you live, no matter what the markets do. The biggest financial risk retirees face isn't a market crash, it's living longer than expected. If you retire at 65 and live to 95, your money must last 30 years. An immediate annuity transfers that risk to the insurance company. I learned the value of guaranteed income by watching earlier generations. Those with pensions lived more comfortably in retirement than those relying solely on savings, even when the savers had more money overall. My recommendation is this: between ages 70 and 75, consider allocating 20 to 30% of your retirement savings to an immediate fixed annuity that covers basic living expenses. Housing, food, utilities, healthcare. Everything else comes from your investment portfolio. That creates a financial floor you cannot fall below. For example, a 70-year-old with 5 and might allocate $150,000 to an immediate annuity generating around $900 per month for life. Combined with Social Security, that provides dependable income regardless of markets or lifespan. Only buy these from highly rated insurers. Only work with fee-based advisors. And never annuitize all your money. Liquidity and growth still matter. Next comes the fifth and final investment retirees should own before 2026: utility and consumer staple stocks. These are the businesses that provide electricity, water, gas, food, household products, things people buy no matter what. They're boring companies, and boring is exactly what retirees need. These businesses have inelastic demand, pricing power, reliable dividends, and lower volatility than the broader market. During crashes, they typically fall less. During recoveries, they rise more slowly, which is perfectly fine when preservation matters more than excitement. I've owned companies like these for decades. They generate steady cash flow through every economic environment. For retirees, I recommend allocating 20 to 30% of your stock portfolio to utilities and consumer staples, either through individual stocks or diversified ETFs. Focus on strong balance sheets, essential services, and long dividend histories. Now let me show you how everything fits together into one complete retirement portfolio. Now let me show you how all of this comes together into a complete retirement portfolio designed for safety, income, and long-term stability. Let's assume you're a 65-year-old retiree with $750,000 in savings. Here's how I would structure that portfolio. First, a bond allocation of 40%, or $300, and of that amount, $100,000 would be placed in types with laddered maturities. $125,000 would go into short-term treasury bills staggered between 3 and 12 months. The remaining $75,000 would be invested in high-quality corporate bonds. Next, a stock allocation of 40%, also $300,000. That would include $120,000 in dividend aristocrats, $90,000 in utilities and consumer staple companies, and $90,000 in a broad market index fund to provide long-term growth. Finally, an annuity allocation of 20%, or $150,000. This portion would be used between ages 70 and 75 to purchase an immediate fixed annuity that provides guaranteed lifetime income. This structure delivers multiple layers of protection. You get safety from government securities and high-quality bonds, income from dividends and interest, growth from equities, inflation protection from Type S and dividend-growing stocks, longevity protection from the annuity, and liquidity from treasury bills and marketable assets. Now let's talk about income. From this $750,000 portfolio, you could reasonably expect around $12,000 per year from bond interest, assuming a 4% yield on $300,000. Stock dividends could generate roughly $9,000 annually, assuming a 3% yield on the equity portion. Once the annuity begins, that could add another $12,000 per year. That totals approximately $33,000 in annual income, or about $2,750 per month before Social Security. When combined with Social Security benefits, most retirees would enjoy a comfortable income while still preserving their principal. So why must all of this be done before 2026? The timing matters more than most people realize. Several forces are converging that will likely reshape the opportunity set between now and then. First, interest rates are highly uncertain. Today's Treasury bill and TIPS yields are attractive, but they won't last forever. If rates fall, you'll miss the opportunity to lock in today's income. If rates spike during a crisis, quality bonds may be difficult to access at reasonable terms. Second, stock valuations. High-quality dividend-paying companies are fairly priced today. If markets fall, prices may be better, but you'll be buying during fear and panic. If markets rise, you'll simply pay more for the same businesses. Third, annuity payout rates. These are directly tied to interest rates, and current payouts are the best we've seen in more than a decade. If rates decline, annuity income will decline as well. Fourth, policy risk. Tax laws, retirement account rules, and even Social Security could change significantly in the 2025 to 2026 window. Positioning yourself now under current rules gives you certainty and flexibility. Over my lifetime, I've learned that the best moment to prepare for uncertainty is when you still have time and options. Once a crisis arrives, choices disappear, and decisions become reactive rather than deliberate. There's one final piece that's absolutely essential: rebalancing. These 5 investments are not a set it and forget it strategy. I recommend reviewing your portfolio quarterly and rebalancing at least once a year. If stocks perform well and grow to represent 50% of your portfolio instead of 40%, trim them back and add to bonds. If Treasury bills mature and you don't need the cash, roll them over or deploy them into assets that have declined. If dividend income increases, decide whether to reinvest or take it as cash depending on your needs. This disciplined process forces you to buy low and sell high automatically without trying to predict markets. It's a strategy I've used for decades, and it's one of the reasons I've been able to compound wealth while avoiding catastrophic losses. As I close, I want to leave you with a principle that has guided me through 94 years of investing. In retirement, your goal is no longer to maximize wealth. It's to protect what you've built while generating dependable income. These 5 investments do exactly that. They won't make you rich overnight. They won't give you exciting stories to tell. They won't outperform the latest speculative trend. But they will give you safety, income, and peace of mind, and that's what truly matters in retirement. I've seen too many retirees chase returns in their 60s and 70s, taking risks they couldn't afford, only to reach their 80s with far less security than they should have had. Don't let excitement steal your stability. Don't let greed override caution. Don't let fear of missing out undo a lifetime of hard work. Own these 5 investments before 2026. Sleep well knowing you're prepared for whatever lies ahead, and spend your retirement enjoying life, not worrying about money. That peace of mind is the most important return you'll ever earn.